Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Pure Storage.
If you find our talks useful, please consider subscribe, like, and comment underneath. Okay, so let's unpack this. I have to admit, when I saw the topic for today, my first thought was storage. Really? Are we spending our time on hard drives? Because, and no offense to the tech, that just feels a little bit like talking about filing cabinets in the age of the internet.
Yeah.
Sounds so utilitarian, a bit boring.
It's funny you say that because that is exactly the misconception. That's where the opportunity is.
Okay.
If you think storage and you're picturing those loud spinning magnetic discs from the 90s, you were looking at the wrong movie.
That is what I'm picturing.
We aren't talking about digital attics where you throw old photos to, die. We are talking about high performance, all flash storage. And here's where it gets fascinating. This isn't just for saving files. This is the actual brain capacity for the AI boom.
The brain capacity for AI. Okay, that definitely sounds sexier than filing cabinets. But help me connect the dots. We usually hear about the brain being the chips, right? The NVIDIA GPUs doing all of the thinking.
Think of it this way. Everyone is talking about NVIDIA chips or Meta's massive language models. Those are the engines.
Right.
But an engine needs fuel, and in the AI world, that fuel is data. Massive, massive amounts of it. And you can't feed a Ferrari with a garden hose.
You just stall the engine.
Exactly. You need data that can move instantly with zero latency. If that really expensive GPU has to wait even a millisecond for the data to arrive from a hard drive, you're just wasting money. That is what Pure Storage does. They provide the high-speed infrastructure that lets those AI models actually learn without hitting the brakes.
So if NVIDIA is the race car engine, Pure Storage is the high-tech fuel injection system.
That is the perfect analogy, and they do it through something they call the Unified Enterprise Data Cloud. Now, I know that sounds like a marketing mouthful.
It definitely sounds like something written on a whiteboard in Silicon Valley.
It does. But what it means practically is that it's an architecture that is fundamentally different from those legacy storage systems. It's cleaner, it's faster, and much more energy efficient. And that energy part is becoming a huge deal.
Oh, for sure. Data centers are sucking up power like crazy.
Right. So if you can store the same amount of data using half the electricity because you aren't spinning physical disks, that is a massive operational advantage.
Okay, I'm listening. So we aren't betting on hard drives. We are betting on the critical infrastructure of AI. Let's look at the scoreboard, though. Does the money back up the story? Because cool tech doesn't always equal a good stock.
It definitely does in this case. Let's look at the Q3 numbers for fiscal year 2026. They brought in $964 million in revenue.
Okay.
That is up 16% year over year.
16% is solid. It's not that explosive to the moon growth, but for hardware infrastructure, that's actually pretty healthy, isn't it?
It is very healthy. But the key here isn't just the current number, it's the trajectory. They are accelerating. They raised their full-year guidance to $3.63 billion, which is almost 15% growth. But here's the kicker. Analysts are projecting that to ramp up to nearly 18% growth in fiscal year 2027.
So the snowball's actually rolling faster. That's interesting because usually as companies get bigger, growth slows down.
Yeah.
You're saying they are defying gravity a bit.
Precisely. And that acceleration is largely because of that AI demand we just talked about. We are moving from the training phase of AI to the application phase where they need to access all that data constantly. That is Pure's playground.
Right.
But, and this is where we need to put our analyst hats on, there is a number in the report that usually scares people off if they don't get the context.
I think I know where you're going. I was looking at the margins. Is it the gap between the gross and the net?
The profitability paradox, yes. If you look at their gross margins, they are massive, almost 70%, 69.8 to be exact.
Which is incredibly high for a company that sells hardware. I mean, that's software territory.
Exactly. It shows their efficiency. But then you look at the net margins, the actual bottom line, and it's only 3.7%.
Whoa. That is a huge gap. You're making almost 70% profit on the product, but taking home less than 4%. Where's all that money going?
That is the big question. They had about $130 million in net income. And to the untrained eye, that looks thin, it looks risky, but you have to look at why that gap exists. They are pouring that cash right back into the business, R&D, sales expansion, capturing market share.
So are they just burning the furniture to heat the house? Or is it more strategic than that?
It's strategic. When you have a gross margin that high, it means the core business is extremely healthy. The low net margin is a choice.
A choice.
It's a choice to reinvest for growth. They're trying to grab land in the AI data center market before competitors can catch up.
So they are choosing to get bigger rather than richer right this second. That makes sense if the opportunity is massive.
Correct. And despite that thin net margin, they are generating robust free cash flow. That is the real safe money indicator. Cash flow is truth.
Speaking of safety, let's talk balance sheet.
Yeah.
Because if things go south, you want a cushion. I'm seeing $4.22 billion in assets against $1.61 billion in liabilities. That seems pretty bulletproof.
It is a fortress balance sheet. They have plenty of cash to weather a storm. And management knows it. This is one of my favorite signals in this report. They just authorized a $400 million share repurchase program.
The buyback. Now, let me play devil's advocate here. Sometimes companies buy back stock because they just run out of ideas. Is this one of those?
I don't think so. Not with their R&D spend. This is the largest buyback authorization ever for the company.
Yeah.
This is management looking at the stock price, looking at their future and saying, we are the best investment we can make right now.
It's a vote of confidence. They are betting on themselves.
Exactly.
Okay, so we have the AI growth story, accelerating revenue, and a management team putting their money where their mouth is. But why Pure Storage specifically? Why not Dell or NetApp? There are giants in this space. What's the moat?
This brings us to their business model, which is actually quite brilliant. It's called Evergreen One.
Evergreen. Sounds like a subscription service for your lawn.
Close. It's a subscription service for your data center. You know what a forklift upgrade is in the IT world?
I assume it involves heavy machinery?
Metaphorically, yes. In the old days, you'd buy a massive storage array, use it for 5 years, and then it would be obsolete. You'd have to rip it out, buy a new one, migrate all your data. It was a nightmare.
I can imagine. Expensive, risky.
And slow. Pure Storage changed the game. They sell it as a service, you subscribe to the storage, and when the hardware gets old, they upgrade it for you, non-disruptively.
Ah, I like that. It's like leasing a car, but they swap out the engine for a newer one while you're driving it, so you never have to buy a new car again.
That's a great analogy, and think about what that does financially. It turns a one-time hardware sale into recurring revenue. That's why analysts are forecasting almost 36% earnings growth. It's sticky.
Once you're in, you're not leaving.
The switching costs are just too high. You are not going back to the rip and replace nightmare. No CIO wants that headache.
Right.
And this model is winning. Gartner, the big tech research firm, has recognized them as a leader, and more importantly, they're landing partnerships with the giants. They're working with NVIDIA, they're working with Meta.
Meta?
Yes, Pure Storage is part of the infrastructure for Meta's AI research supercluster. These companies don't mess around with second-tier tech. If Pure is good enough for Meta's AI clusters, it's good enough for pretty much anyone.
That validation is huge. Okay, so the business is solid. What about the stock? How is the market treating them?
Well, the market is definitely waking up. On January 12th, the stock popped nearly 9%. And then it gained another, 3.7% after the Needham Growth Conference?
People liked what they heard?
They did. And the technicals are looking very interesting right now. We are seeing what looks like breakout potential. The stock has been consolidating, but the current setup suggests it could be targeting $95.
95. That would be a nice move from here.
Yeah.
But stocks don't move in a straight line. What's the volatility like?
Oh, it can be a wild ride. You have to have a stomach for this. There was a point recently where the stock dropped almost 21% despite good news just from profit taking. It's a volatile sector.
Okay.
But the sentiment right now, according to the Alpha Vantage data, is somewhat bullish.
Somewhat bullish. That sounds lukewarm. Why is that a good thing?
I actually prefer it to euphoric.
Yeah.
Euphoria is dangerous. When everyone loves a stock, there is nobody left to buy. Somewhat bullish means there's still skepticism. It means there's a wall of worry to climb, which drives prices higher.
Speaking of worry, I saw a headline that might make some people nervous. The chief product officer sold almost $500,000 worth of stock. When I see insiders selling, my first instinct is to run.
Context is everything here. Yes, he sold $482,000 worth of stock. That sounds like a lot of money to us. But for him, it was only a 3.8% reduction in his holdings.
Oh, so he still owns 96% of his shares.
Exactly. And collectively, insiders still hold $1.1 billion in value in the company.
Okay, so he's buying a beach house,
No.
not fleeing the country.
Right. It's not a fire sale. And on the flip side, look at the institutional moves. Pure Storage actually participated in a $70 million investment round for a company called Wasabi.
Wasabi, like the spicy green stuff.
Wasabi Technologies, they do cloud storage, but it's a strategic investment. It shows that big institutions and Pure itself are aligning to expand the ecosystem. They aren't just selling a box, they're building out a whole world of storage solutions.
Got it. So the insider sale is a nothing burger, and the institutional money is still flowing. Let's look at the calendar. If I buy this today, what am I watching for in the next 3 months? What are the catalysts?
The big one is obviously earnings. We have Q4 fiscal year 2026 results coming in early March.
That's coming up fast. What's the bar they need to clear?
The consensus is expecting over $1 billion in revenue for the quarter. That would be a 17.3% jump. And that billion-dollar mark is psychological as much as financial. If they hit that, it confirms the acceleration story is real.
And if they miss?
If they miss, with those thin margins, it could get ugly fast. That's the risk. But there are other tailwinds. Watch for John Colgrove, the founder, making appearances. He's been out there telling the story, and usually when founders are loud, it means they are confident.
What about the macro picture? Supply chains, all that. I've heard rumors about shortages in memory chips.
This is where it gets really interesting. We are seeing supply tightness in the NAND and DRAM markets. Those are the memory chips that go into these storage units.
Usually supply tightness is bad, right?
It can be, but if you have pricing power, it's actually good. It pushes prices up. And Pure Storage has shown they have pricing power because their customers aren't buying based on price, they're buying based on speed.
So they can just pass the costs along.
They can. Plus, you have easing tariffs between the US and Europe helping with distribution. So the macro winds are actually shifting in their favor.
Okay, we've been pretty positive. But my job is to play devil's advocate. What keeps you up at night with this stock? What is the bear case?
It's important to look at the downsides. The biggest one is valuation. They are trading at a premium, about 7.2 times sales.
How does that compare to, say, Dell?
Well, a legacy company like Dell trades at less than 1 time sales. Now, Pure is growing much faster, so they deserve a premium, but 7.2 is steep. When you pay a premium price, you are demanding perfection.
So there is no room for error.
Very little. Remember those net margins? 3.7%. That is thin ice. If AI adoption slows down even a little bit, or if a big customer like Meta cuts back on spending, that 3.7% can turn into a loss very, very quickly.
So we are heavily dependent on the hyperscalers, the Googles, Metas, Microsofts, keeping the spending tap open.
We are. If the AI gold rush ends, nobody buys shovels.
That's a fair warning. So weighing the gold rush against the thin ice, what is the verdict? Give me the score.
I'm giving this a bullish 8 out of 10.
8 out of 10. That is pretty high confidence.
It is. Here's the thesis. Pure Storage is arguably the best pick and shovel play for the infrastructure side of AI right now. You have 16% revenue growth that is accelerating. You have massive gross margins, and you have a $400 million buyback, putting a floor under the stock price.
It feels like a multi-year hold, not a quick trade.
It is. This is a position you hold into the AI adoption cycle. The target is $95 and above. I think it is currently undervalued relative to where it will be in 12 to 24 months.
So effectively, you're buying the toll road for AI data.
Exactly. And unlike a lot of AI stocks that are all hype and no revenue, these guys are printing almost $1 billion a quarter.
That is a distinction worth making. Real revenue, real product, real customers. So to wrap this up for you, Pure Storage. It's not your dad's hard drive company. It's a high-tech, all-flash, subscription-based infrastructure play powering the AI revolution. The stock has momentum, management is buying, and the experts see a breakout to 95. But keep an eye on those margins and the earnings report in March, because on the cutting edge, the ice can be thin.
Couldn't have said it better myself.
Before we go, I want to leave you with one final thought. We talked about digital fossils earlier. It really makes you wonder, in 5 years, will the spinning hard drive be as obsolete as the floppy disk? And if so, how much of the world's data is currently sitting on fossil tech that needs to be migrated to flash? The answer to that question might just be the size of the opportunity we're looking at.
It's $1 trillion question.
Indeed it is. Thanks for tuning into Smart Wealth with Joshua. We'll see you in the next one.